What are the signs indicating to you right now about whether these averages correlate or whether the S&P makes a stand?
Yeah, well, Joe, thanks for having me. And what's particularly interesting is how important the top 5 names in the S&P, which are obviously Apple, Alphabet, Google, Amazon, et cetera, have dominated the market over the last couple of years. Those 5 have a multiple of 29 times earnings. If you look at the rest of the S&P, 495 names, the multiple of that part of the market is about 16.5 times earnings. So the market sells for 18.5, but it's really been driven by those top names that dominate the NASDAQ. If the market comes down, 5% more, and all equaling, we talk about the S&P selling for those 495 names, selling for 15.5 times earnings, that's a pretty reasonable number. That's a level where I think we can have support and feel as if the market can start to stabilize and move higher. It's those 5, and Tesla is pretty dominant now in the market because it's in the S&P. It's a huge factor, and of course it's a very expensive stock, which has been coming down. So I think that we're trying to find a place of stability, and as Mike pointed out, we bounced around. We've come off this level back at the March 14th lows a few times, but I think we can get through earnings. The earnings yesterday were fine. I mean, Google wasn't great. Microsoft was solid. Visa was very, very strong. And, we need to see a few more names come in with really strong, reliable, and sustainable earnings so investors can get back on board before we can start to see the buying again.
If you had to put your finger on what's ailing stocks right now, obviously it's a rising interest rate environment. But as Mike pointed out, that hasn't been the problem the last couple of days. Are we closer to are we getting near the terminal rate? Is 3.5 maybe on the 10-year? Will that be enough if the markets continue to swoon to where we maybe don't have that far to go in terms of rates going up?
Yeah, well, I think that's a good point. We've been feeling that, 325 would be about where we could stabilize. And it feels as if investors are worried about a recession. When we see stocks slide the way they have because of fears of the recession, then interest rates seem to come back into this, 275, 280 area on the 10-year. And that's more comforting to investors. If we're thinking mentally, if the market thinks we're at 4%, 4.50, 5%, that's very worrisome, and that puts a lot of pressure on markets. So that I think felt pretty good yesterday. Another interesting point is that investors have used Apple, Microsoft, and Google to some extent as their money market fund. It's a circuit. You just park money there while you wait to see what else happens in the market. When interest rates go above 3%, there's an alternative. You can start to see money move from those big names out, and that's some of what has happened. That's why these stocks are down 20% recently. But, having interest rates seem more stable would be very good for the market.